Oil prices edged higher on Monday, supported by growing expectations of increased fuel demand during the summer months. Brent crude futures rose by 15 cents, or 0.2%, to $79.77 a barrel as of 6:44 GMT, while U.S. West Texas Intermediate (WTI) crude futures increased by 10 cents, or 0.1%, to $75.63 a barrel. Despite this uptick, gains were capped by a stronger U.S. dollar, which appreciated following higher-than-expected job additions in the U.S. last month. This economic data led investors to trim their expectations for imminent interest rate cuts, thus boosting the dollar. A stronger dollar generally makes oil more expensive for holders of other currencies, thereby limiting potential gains in oil prices. In addition to the dynamics of the U.S. dollar, the euro faced pressure due to political uncertainty in the eurozone. French President Emmanuel Macron announced snap legislative elections for later in June after experiencing a significant loss to Marine Le Pen's far-right party in the recent European Union elections. According to Tony Sycamore, a Sydney-based analyst at IG, this political development adds another layer of uncertainty to the market, particularly following the upside surprise in U.S. non-farm payrolls, which has caused yields to increase sharply. Sycamore noted that the market's attention is now focused on the upcoming meetings of the U.S. Federal Reserve and the Bank of Japan this week, where the risk of more hawkish outcomes could further influence market sentiment. Concerns also persist regarding the plans by the Organization of the Petroleum Exporting Countries and their allies, known as OPEC+, to unwind production cuts from October. This move could potentially add to the rising global oil supply. Last week, both Brent and WTI posted their third consecutive weekly losses on these concerns. The announcement by OPEC+ coincided with a reported rise in total commercial crude and product stocks in the OECD region to an estimated 48 million barrels in May, compared to the average build of 30 million barrels during 2015 to 2019, as highlighted by energy consultancy FG in a note. Despite these headwinds, analysts and traders remain optimistic that increased summer holiday demand will help reduce stockpiles and support oil prices. FG continues to expect the market to firm up, projecting crude prices to reach mid-$80 per barrel levels as we move into the third quarter of 2024. However, they caution that this price recovery will likely need a convincing signal of tightening from preliminary inventory data. Supporting this outlook, Goldman Sachs analysts anticipate Brent crude to rise to $86 a barrel in the third quarter, driven by healthy consumer demand and solid summer requirements for transportation and cooling. They predict that these factors will push the market into a significant deficit of 1.3 million barrels per day during Q3. In recent months, the global oil market has been characterized by a delicate balance between supply and demand dynamics. The ongoing conflict in Ukraine has contributed to volatility in energy markets, with sanctions on Russian oil exports affecting global supply chains. Additionally, the reopening of major economies post-pandemic has led to a surge in energy consumption, further straining supply. OPEC+ has played a critical role in attempting to stabilize prices through coordinated production cuts, but the group's future strategy remains uncertain as member countries grapple with their individual economic needs and the broader global economic landscape. Furthermore, environmental concerns and the transition to renewable energy sources are exerting long-term pressure on the oil industry. Governments and corporations worldwide are increasingly committed to reducing carbon emissions, which could dampen future oil demand. However, in the short to medium term, traditional fossil fuels like oil are expected to remain a significant component of the global energy mix, especially in regions with rapidly growing populations and industrial sectors. The impact of inflation and interest rate policies by major central banks also continues to influence the oil market. Higher interest rates can lead to a stronger dollar, as seen recently, which tends to suppress commodity prices, including oil. Conversely, lower interest rates can stimulate economic activity and increase energy demand. The upcoming meetings of the U.S. Federal Reserve and the Bank of Japan are particularly critical, as their policy decisions could either support or hinder the recovery of oil prices. Looking ahead, market participants will closely monitor inventory levels, production data, and macroeconomic indicators to gauge the trajectory of oil prices. Analysts suggest that any significant deviation from expected supply or demand patterns could lead to sharp price movements. For instance, unplanned production outages or faster-than-anticipated economic recovery could tighten the market more quickly than forecasted, driving prices higher. In summary, while oil prices are currently nudged higher by the anticipation of strong summer fuel demand, several factors, including a stronger dollar, political uncertainties in Europe, and concerns over OPEC+ production strategies, are contributing to a complex and cautious market environment. The upcoming central bank meetings and the evolving global supply dynamics will be critical in shaping the future trajectory of oil prices. Market participants remain vigilant, balancing optimism about summer demand against the myriad uncertainties that continue to loom over the global oil market.